Welcome everyone to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. We have a fascinating conversation lined up for you today. We're going to hear how one Canadian couple is using their options income ETFs to help support their early retirement lifestyle. And get this, they say they're living off of the income distributions alone. We're going to find out how they pulled off the Canadian dream of financial independence and how options income ETFs have helped them out. Without further ado, let's bring in today's guest speakers. Joining us are Adrian and Erica, co-founders of the Passive Income Investing YouTube channel. They share their financial journey to financial independence and detailed breakdowns of how they're investing during early retirement. Adrian and Erica, welcome back to the show, and thanks so much for stopping by to chat.
Thanks for having us.
Good to be back.
So you retired to Panama before age 40, and you say that your portfolio's income alone can support your lifestyle. That sounds absolutely incredible. So what does a day in your life actually look like?
Pretty chill, I would say. So I just want to say the word retirement, I don't really like that word. I prefer financial freedom, financial independence, because we're still running the YouTube channel. So just because you're, retired doesn't mean you can't stop earning income or, having a side hustle or a side business or hobbies, etc. So I'm definitely focused on that, I would say. I have my own hours. I wake up whenever I want. It's typically 10:30 a.m. I'm a night owl, always been, always will be. So it's pretty chill. It's pretty fun to do whatever you want, not having a boss. And yeah, we're just enjoying the weather, enjoying the lifestyle here.
Yeah, I think he's being a bit modest because he often does a lot of research, and he's, we've got our YouTube channel and we've got a lot of people in the community. So we're pretty much engaged with that, throughout the week, and we're answering questions. We're setting up meetups and other fun things that we do with the community. So aside from that, he's on research mode, and he talks to fund managers. He sets up the Q&As, and he basically filters all the questions that we get from via comments or emails or messages, and tries to address them as much as possible via, a script writing for videos, or getting the fund managers to come on the channel and answer those questions directly. So he's busy. He's pretty busy, I would say. I'm more trying to build roots with the community here in Panama. There's a lot of Canadians, which is super cool to meet other Canadians from across the nation. A lot of veterans, they retire, after the 25 years. So they're not in their autumn of their life. They're still very vibrant and alive, and they love to do things. And there's a big community that does outdoor activities, hiking and stuff like that. So I'm trying to get us more in the social beat of it. And it's cool meeting the people that are here, the expats, the Americans, Canadians, Europeans, people from, Asia, South Africa. So that's pretty interesting. We're still very much new to the place, and we're getting to know the area.
Okay, I was going to say, don't tell me you don't have any fun at all, that it's all work all the time.
Oh, no. We have a lot of fun. We definitely have a lot of fun, yeah.
Yeah.
Good. You still get the time for the relaxation and enjoying the climate that you're in. Okay, good.
Yeah, we have to take advantage, of course.
Absolutely. Yeah, absolutely. What were some of the biggest factors that helped you both reach financial independence so early in life?
Yeah, so there's quite a bit. I mean, it's really about taking care of your financial health as early as possible, the sooner you start. And it's really good basic things that everyone could do, no matter, how much money you make, what your income level is, what country you're from, it doesn't matter. You got to have good financial habits. So an important one, I think that number one, the most basic thing is you have to have, I hate saying the word budget, but you have to know what's coming in versus what's going out. That's very, very important. You have to know what's going on with your, financial health, just like your health in general, right? So that's number one. And
for us personally, we started off by paying off our debt, so student loans. car payments. So as soon as we were working the 9 to 5, we were in our early 20s. Back then, we got into IT. Both of us, we met in an IT company. So we were younger. We were in our early 20s. So, I had a student loan. So I was just trying to pay that off. That was like my first big thing that I had to pay off. So with that, I kind of developed the habit of paying off, credit card right away, whatever it was just a habit for me to take care of the debt, because I don't know, it just made me sleep better. It's just, knowing that I didn't have that hanging. So I think that's the main, I think, kind of point that to come across is that if you don't know what money is where to allocate the money, then you just tend to spend it recklessly instead of addressing what your debts are. So really tracking expenses, I think that's the most important thing. Understanding how much money is coming in versus coming out and where it's going. So I think
that's very, very foundational, very basic. Really, the main thing I would say I would credit it to is that our excessive, income our disposable income rather, we typically just threw it on the mortgage right away. That's what really helped us get there very, very quickly. So we paid down a 20-year mortgage in 7 years. Which definitely helped a lot, because then all of a sudden you don't have a mortgage payment and you have much more disposable income. And that's what actually prompted me to say, okay, now I really got to figure out what to do with this disposable income. And that's when I started researching and got into really getting serious with investing. And then shortly after, income investing, which we're going to talk all about, I'm sure.
There's always the question of, should I pay down my mortgage or should I invest my money?
Mm-hmm.
There's a lot of information on the internet about that stuff. People have different opinions, and they talk about what if your return rate is higher than the interest rate you're paying on the mortgage, then yes, it's worth it, and so on and so forth. So it definitely depends on the person. But for me specifically, I never liked debt like we talked about earlier. So it was the simplest thing to do was to allocate all disposable income towards the mortgage after expenses, obviously after living expenses. And so that at least we know for sure that the value of the house is generally going up, the condo is generally going up, and our mortgage is going down. So when we do sell, it's literally, we don't have to put anything towards the mortgage afterwards. It's completely, 100% our money.
Yeah.
So that's exactly what we did. So in 7 short years, and it was 7 years of grinding, I would say it was, I don't want to seem like we're obsessed with it, but it was really a focal point that we wanted to do.
Yeah.
We wanted to get rid of the mortgage. And then afterwards, it was like he mentioned, we had all this disposable income because we still had those 2 nice salaries coming in. And that's what really, it kind of the momentum of investing really shoots up, because you're adding a big chunk every month, right? So, but if you really don't know anything about investing and you're overwhelmed by all of the information,
pay your debts,
pay down the mortgage, and you'll see how doing that will inevitably get you to a point where, okay, now I could look into this with more, because I got money, I've got more disposable income, I got something here. So instead of just like kind of being up in the air of it, you have more of a targeted approach.
Yeah.
So that's just my opinion.
Yeah, no, that's the main thing. There's other little things I could say. We've never bought a new car ever.
No, that's true.
Things like that, that's more of a given. You get raises, you get a bonus, you raise your RSP contribution, you raise your mortgage payment.
Pay to yourself.
I would always send,
Yeah.
exactly. I would always, whenever we get a promotion or a raise, or I would always email my banker, please take an additional $50 a month. An additional $50 a week on the mortgage, for example, right? So you got to have that discipline too, instead of just spending it, do the financially responsible thing. Yes, it's delayed, gratification, if you will, but it is worth it, because retiring 5, 10, 15, 20 years earlier, that's a really big total return.
Yeah.
It's priceless. So.
Absolutely. So talking about the retirement piece, how did you guys actually figure out how much income you would need to support your early retirement? You were, paying off your mortgage, your financial situation was changing. How did you know what it was going to look like and how much you'd need kind of per year to support your retirement? Or I know you don't like the term retirement, but your alternative
Life
type of hybrid
Lifestyle.
lifestyle, hybrid self-employed lifestyle.
Yeah, well, I think it was more just the tracking and the process of tracking your expenses. So every month the tracking includes all the living expense, and there's a big buffer for unforeseen costs. So there's never any surprises. And also within that tracking, budget, there's money for reinvesting. So just like a paycheck, you would always allocate some of your paycheck towards investing. So we do the same now, even though we're technically retired or financially independent. So I would say tracking your expenses is the number one thing to see how much you need per month to live.
Yeah.
And really exaggerate it so that there's no surprises. So add, like when we talk about entertainment, streaming services, restaurants, we just put the times, like I would say times 4, just to really exaggerate it so that we don't feel tight with our budget. So we're able to see it in black and white every month, what the amount of money that we require, and that because we're reinvesting, our income every month from our portfolio actually increases. So every month we're in a better shape than the previous month. So it's really about having the discipline to put all of your stuff on Excel, track it, because it's worth it. It seems like, very like, kind of a low budget thing or like low tech, but the Excel sheet with the those formulas that just add all the money at the end.
It's very low tech. There's apps for it now. You could even go lower tech and write it down.
Yeah, exactly.
Paper. But you got to figure out what your FI number is, right? What is you got to track all your
expenses, and that includes your rent or your mortgage, groceries, phone bills, insurance, unforeseen costs. I have to really exaggerate on this because it's true. There's always something that happens, right? So you bust the tire on the car, your windshield breaks, something happened, whatever, you need to give some money to your friend or loan some money out. So emergency. This is always an exaggerated, So based on that, and what, we always wanted to increase our expenses. We didn't want to say, okay, well, this is going to be it for the rest of our lives. So we always, every year we anticipate, inflation, or if we want to rent a bigger place, if we want to go on an extra vacation. So, those details, and it's like we make it like kind of like part of our date night where we discuss it, and it's really being in tune with the finances. I think that's important, and having the discussion together, which
reaching, getting enough income or passive income that covers your monthly expenses that's financial freedom. But I would say that's like step 1, right? That's a big step that not many people get there in their 30s and 40s. That's a huge step. But it doesn't mean you got to keep going. You got to keep investing. You got to keep going because prices of things goes up typically. Plus, then if you want to travel, if you want to do other things, so you got to keep going to keep investing and keep generating more and more cash flow. So step 1 is obviously very important. You figure out, okay, I need $4,000 to live comfortably. 5,000. It's different for everyone depending. Your province, if you're in the city, you're out of the city, it's that FI number is completely different for everyone because some people want to do travel, some people don't really interested in that. So it depends for each person, but you got to figure out what yours is. And like Erica said, shoot higher.
Yeah.
Put another $500,000 just in case. And you're just getting more and more and more comfortable, and you'll just sleep better and better and better. Right. And obviously be in tune with your partner, discuss it, and make sure you know what's going on in your finances. Yeah.
So what was that number for you guys? What was that kind of income that you needed to hit in order to be comfortable in your financial independence?
If I remember correctly, in Montreal in about 2019 or something like that, it was a little over $4,000 to be relatively comfortable, paying the rent, the expenses. Now it would probably be much more than that, maybe 5,000 at least, because the costs, especially in Canada, went up. But again, it's different for everyone. That it really depends. If you have kids, if you don't have kids, if how extravagant do you want your lifestyle to be? It could be some people $3,000 is okay. So it really depends on your lifestyle that you want to achieve, right? You could do it much much smaller budget. That's fine. So if I remember correctly, it was something like 4,000, something like that.
4,500. Yeah.
Something like that. Yeah.
So my
Yeah.
goodness, we are getting so many questions in, so we'll try and get through them as quickly as we can, just so we can make sure that we hit as many as possible. We're going to talk a little bit about the investing side of things. You're a big proponent of high yield income funds that use options trading strategies to get that modest amount of, as well as a modest amount of leverage, like covered call ETFs. So can you tell us a little bit about covered call ETFs at like a high level? So sort of some basics around that.
Yeah, sure, not a problem. So the best way I could explain, first of all, covered call ETF is just like every other ETF. It could be an index-based ETF like an S&P 500, a NASDAQ 100. It could be a dividend-style ETF. Covered calls is just what they add on top, right? So, you have S&P 500, which everyone knows, and then you could get an S&P 500 covered call ETF. So both investors are essentially investing in the same thing. They're just getting their return in a different way. That's the best way I could explain it. So a covered call strategy, it's one of the most basic option strategy that's been around since the 60s or something like that. The covered call ETF market in Canada really started, I think in about 2010, 2011 is when they first started coming out. So the ETFs have been out for a decade and a half, but the strategy has been around for a much, much longer time. Right. So essentially, when you're doing covered calls on something, whether it's one stock, whether it's on an index, whether it's on a group of dividend stocks, you're basically the fund manager, because it's an ETF, so it's the fund manager is doing it, is writing call options on the stocks inside the ETF. So what does that mean? What happens when you're selling call options? It means basically you're giving up. This is the key to understanding what the covered call strategy is. You're giving up some upside, potential upside. So if we just stick to the S&P 500 example, you're giving up some of the upside of the S&P 500 for those call premiums, aka that passive income. So that's really the biggest thing that a covered call ETF does. The second, more secondary, in my opinion, is actually lowers your volatility, aka your risk. So if you have an S&P 500 ETF, S&P 500 covered call ETF, covered call version actually has lower risk, lower volatility, and you'll typically see that kind of language on all the websites because you're kind of getting that income is a cushion for the bad times, right? So you're capping your upside, yes, that's the con, but the pro is you're cushioning the downside during the bad times. So
it's also for the consistency of the monthly income. So
that's what they're designed for.
They're designed for that. So typically they're designed for retirees. So they're marketed towards people who are 65 plus. And that's the reason, because they have a set amount of money that they will receive every month from the covered call. So it gives more of a sense of stability. So
yeah. So that what you're showing there on the screen, the anatomy of a covered call, that's, it's going to be pretty complicated and hard for someone who's new at options, but the essential concept is you're giving up some of the upside, which is capital appreciation of your ETF or your stock, whatever it is you're doing covered calls on, for income. So if the S&P 500, let's say, goes down 5% in 1 month, both ETFs are going to go down 5% because they're the same assets. But the covered call ETF has that nice monthly income where the index fund does not. So that's the actual cushion. It's that consistent income. So what you do with the income is up to you. You could spend it all. You could reinvest half of it. You have more flexibility than the guy who owns the index fund because there's not really much income there. You're basically dependent on the stock market going up and then selling it to make a profit, right? Whereas a covered call ETF, you just hold them, and every month you get the income. You do what you want with the income without needing to sell that ETF.
Right, and the idea with those premiums, or with the you're talking about the higher return for retirees, essentially, so you don't have to take away from your principal. The money you originally put in, it continues to grow, and you're just kind of living off of the income, right?
Yeah, and that's why they're marketed more towards people in retirement, because income is more the priority than growth or total return. Exactly. So for sure, the covered call ETF will, I say 99.9% of the time, it's pretty much 100, will in terms of performance versus the one that doesn't have the covered calls, will always underperform long term for two reasons, because the market goes up more than it goes down over the long term. It's
Which
very
is a good
simple.
thing, yeah.
And you're giving up some of that upside. And because they have higher fees versus just the index, because these strategies take more active management. So they do have higher fees versus, non-covered call ETFs.
I'm going to try and ignore the fact that your adorable cat is in the background and focus on the questions that we have.
That's what's fun.
We have a question from Michael, and this is around the same sort of thing we're talking about. So can you tell us about some strategy details around your options ETFs? Are you selling calls or puts, or buying calls, puts? So we did cover that it's covered calls specifically, but maybe you can talk a little bit about maybe why you don't use puts, or whatever the case might be, and talking about those other facts of the question.
Yeah. So that's all handled within the ETF. So I've never bought a call or a put option in my life.
Yeah,
I don't even
have it enabled in our investing.
We don't even have options enabled in our, just like you would buy an ETF because you don't want to stock pick, right? You don't want to pick and choose the individual stocks. So you buy an index ETF or a dividend ETF if you want to buy dividend stocks, but you don't want to stock pick them. Well, covered call ETF is essentially the same thing. So this is all managed within the ETF itself. That's where the management fee comes in, right? You're making the professionals doing the selling and the management of the options. You get your monthly distribution every month. So this is completely transparent. Obviously, it's important to understand the strategy, and each fund manager will have a different covered call strategy. But there's also some put option ETFs, which is kind of like the opposite of a call option. They kind of work the same way. The most common one, I would say 95% of them, of the options income ETFs, is the covered call strategy. That's just how basic and good and well proven this strategy is over time. And you could see, exactly how they react in what type of market, right? So in a bull market, they will typically underperform because the stock prices are going up, the markets are going up, and you're limiting that upside. But in a down market, where there, let's say, is no upside, all those call premiums that you're getting, right, there's no upside. So that's where the cushion comes in. So they tend to outperform during a period of time where the market is flat or going down.
Yeah, if you're interested in covered call ETFs, the best thing to do is actually read the strategy that the fund managers adopt, because each fund manager has their own strategy. So typically there's at the money, in the money, or out of the money strategies. So you'd have to look into that to see exactly what strategy is going on with your ETF. So this is more of a technical analysis, and this is what I was saying about how this is his research mode. This is what he's doing all the time, because he talks about it on the channel, and he has to answer the questions, right? So he has to get informed with all that stuff. But primarily, what we do is get the fund managers directly on the channel to discuss it, because like he said, we invest in those covered call ETFs so that they handle all that stuff. I obviously understand the strategy because I want to know what my money's doing, so I need to know exactly what's going on. But we don't do it. We don't actually do the puts
we're not doing
calls.
the options. Just like we don't buy and sell stocks.
Yeah.
This is all handled within the ETF. You could do your own options. You could buy TD stock, write your own calls and puts. You could do that, but we want to be as passive. We're passive income investors, right? We don't want to do any of that.
It's a whole other ball game. But we know people in our community. We have an active Facebook group.
They do it. Some of them do it.
About it, and so they have success in it. There's a lot of bumps too, because it takes time to understand what's really going on, because volatility is very finicky, right? So it's not so easy to predict what could happen.
For sure. Les has a question here. We're talking a little bit more about your side hustle. So what percentage of the speaker's annual income comes from his portfolio and covered call ETFs, and what percentage comes from his social media courses and mentoring? So how does that look? Like, are you mostly living off of the passive income? I know that you obviously still have some income coming in as well.
It's a question I get all the time. How much are you actually living off your portfolio? How much versus? So it's very hard to say, because the side hustle, so the YouTube channel, the coaching sessions, etc., that varies greatly from month to month. So it's hard to say exactly, but our mission is our goal is to be okay if we've only have the portfolio.
Yeah. So the goal is always to, if we stop everything tomorrow, we'll be 100% covered with the portfolio income. So we base our living expenses based on the income from the portfolio, not anything. Everything else is a bonus for us.
Yeah, and to be clear, I'm sure we'll talk about this. We have, in terms of portfolio, we have two entities, I like to say. The main portfolio, which is what you're seeing here, which is our two TFSAs and our non-registered account. Then we also have the retirement accounts, which is our two RSPs and Lira, which we're not touching at all. So when we say we want to be okay just on our portfolio, it's only the main portfolio. It's even excluding the RSPs, which you're seeing right now. Those are just on drip. They're just compounding away. It's kind of like an additional safety net. So we're pretty conservative investors, and the goal is to be okay just with the main portfolio, if that makes sense, right?
Gotcha. Okay. Yeah, I think that's very straightforward. And then it kind of stops you from trying to like change your spending habits as time goes on. You're just fixed to a certain income, and you're not like, you know, having lifestyle changes based on that money coming in. So that makes complete sense. We have a
just like in our younger
Mike.
days. Yeah. Oh, sorry. We're just gonna say, just like in our younger days, the side hustle money, that's like bonus for us.
But
it's
we're investing it. We're not just spending it willy-nilly.
Yeah, we're investing most of it anyway. So
yeah, I can tell you guys are very fiscally responsible. You definitely are very mindful with your spending and that sort of thing. You know exactly what's going on. That's great. I'm sure not all of us are like that. We have a question here from Mike. So Mike's saying, you mentioned earlier reinvesting is needed to grow your distributions and keep up or beat inflation. So based on monthly distributions, what is the target you would recommend to be reinvested? So we're talking about pre that financial independence. We're still in kind of the building up stage. What would that look like as far as those distributions go?
Yeah, that's a good question. I get that, a typical question like that when it comes to inflation. The best answer I could tell you is there's no magic number. It's as much as possible. That's what our motto is.
We have, like I mentioned, we have a Facebook group, and a lot of these questions come up, and people write what they do, right? What their strategy is. And like we always say, it's very subjective to each individual's lifestyle and what they're spending money on. So if you have a portfolio that generates a certain amount of money and then it covers your expenses, your living expenses, and you have, let's say, 25% is disposable income, meaning that you have a bonus of 25% coming in every month. So essentially that would be, reinvested so that every month you're in a better shape than the previous month. So it really depends on, what you're tracking your expenses, right? So it depends on how much you're going to living expenses and then the disposable income afterwards. So a lot of people in the group, it's between 15 to 40%. So they mentioned that they reinvest either all of it because they're still in the growth stage. So they're reinvesting 100% because they don't need it. They're still working, and then so that just builds up. And let's say you're up to $1,000 a month. So reinvesting $1,000 a month, that's when you see the compounding, that you could see the momentum go high.
Start going,
yeah. So it's really something motivating to see that. So we talk to so many people, young and old, and a lot of younger people, we always say, and we have real examples of, let's say, like a friend of mine who has two daughters that are in their early 20s, and we got them into the index funds and then into the income funds. And they love seeing the income, the distributions every month go in. And because they're reinvesting the total amount, it just increases. So for them, it's very motivating to see that, as opposed to the index fund, like it'll go up, it'll go down,
it'll do what the market does.
Right.
Yeah.
So yeah.
So unfortunately, there's no black or white perfect number or answer. It's different for everyone.
We advocate really about getting to know yourself and your habits, and really anticipating how much you're going to spend versus save. So that's what we advocate. Absolutely. Always DIY.
Yeah, no, I love that. It's very hard. Everyone wants kind of a black and white answer, but unfortunately, everyone is so different that we can't necessarily do that. We talked a little bit about what your retirement portfolio looks like. We showed a quick picture there. So can you actually break that down a little bit and how you're using it to generate the income that you need?
Yeah. So most of it is going to be in the diversified funds. So when you see diversified, this is sector diversified. So they're typically they're pretty much either S&P 500 or S&P 500 based, or maybe Nasdaq 100 based. So it's going to be diversified. Equity just means stocks, and these have 25% leverage, and they're covered call ETFs. So S&P 500, covered calls, and then 25% leverage. It's a very, very simple concept to understand. So those typically will give you yields of anywhere between 12 and 13% annually, paid out monthly. So that's where the majority, I would say, of our portfolio is. And we're going to keep going more and more towards those diversified funds and less into sector specific funds, just because you have less volatility, less risk, right? Diversified versus sector specific. So that biggest portion there, diversified equity, leverage, covered call ETFs, that's what it is. We also have a couple of split funds, a global dividend growth split fund, which split funds are leveraged by nature. Not 25%, it's a bit more complicated to understand, but it's much more than 25%. But either way, the most important thing, you got to look at what you're investing in, right? And that fund there, which is in orange, it's best dividend stock, blue chip dividend stocks all over the world, primarily in the US though. So you'll have names you'll recognize, all boring, big cap blue chip dividend growth stocks. We also have right now a real estate split fund. So this is a collection of the top blue chip REITs, mostly in Canada. This one actually has no covered calls. So it's about 12% yield, something like that. It's real estate.
Basically, when we say real estate, we're talking
REITs.
about, REITs, but we're talking about those buildings, those outdoor shopping malls, they're in every town.
And it's diversified, sticking with that one, it's diversified within the real estate. So like it's shopping malls, but it's also apartment buildings, right, and a lot of industrial as well. Then we have a couple of funds that focus on Canadian equity. So it's mostly financials. It pretty much is financials and energy in Canada. So that those are, again, covered call ETFs, 25% leverage. We have a position in financial split fund, which is top 15 financial companies in North America. Everything we have is almost blue chip, everything except the 8 or something percent like that into crypto funds. So it's just mostly Bitcoin with covered calls. By the way, there's a Bitcoin covered call ETF out there. So you're literally investing in Bitcoin and you're getting monthly income. And a tiny portion in that single stock one, which is just one stock with covered calls. And one thing I didn't really mention, but it's related to covered calls, the more volatile that asset is, the higher the premiums are. The more boring something is, the less premiums you get. So that's a snapshot of our main portfolio, which is a combination of our cash account or non-registered and the two TFSAs as well.
So lots of diversification. This is actually a really pertinent question. So Yael is asking, what is a leveraged fund? So we use that term leveraged a bit, and when you're familiar with it, but can you just kind of highlight what leveraged actually means?
Yeah. Well, leverage is basically borrowed money. You're borrowing money on a percentage of, if you have a mortgage, you're leveraging your house, right? You're borrowing against your house. So what these fund managers do is they borrow 25%, which is a very low and light and modest amount of leverage. It's like taking a $250,000 mortgage on a house that's worth $1 million. So the bank will give you that loan right away. It's not a risky loan. And it really, it amplifies the yield and the performance of the ETF by approximately 25%. So it doesn't mean you're going to get 25% more performance, but you do get, because there's leverage costs. So one thing to remember about the leverage ETFs, they'll have much higher MER fees because leverage costs are included in those, in the MER. But it just amplifies their performance up or down and the volatility. But most importantly for the covered call ETFs, it amplifies your income. So instead of getting 10% yield, you'll get closer to 12.5. So it makes a pretty big difference.
Yeah. The reason why they're interesting and why we're in them is because we're buy and hold. So for the long term, while you're holding the asset, you'll see that the leverage will, like you said, amplify it either up or down. So when the market is bull, it'll amplify it up. If the market is bear, it'll go down. But because you're holding it, you're basically waiting that out, right? So it's just like holding a long-term index. And what the advantage is like you said, is getting that extra percentage on the income, on the yield.
Extra yield.
Yeah. And just to clarify, it's leveraged fund. It's done by the fund managers. Again, we're not doing it. We're not taking out any extra loan or anything. So they are doing it on their end. And because they're financial entities, they get a better rate on the
leverage,
on the
and
money, right? So
you're not going to get margin called. It's
No.
not you taking the leverage inside your account. It's just a leveraged covered call ETF. So there's a lot of great advantages. I call it hands-off leverage.
Yeah.
Because it's not you taking. You don't have to worry about
same concept as not doing the options.
Yes.
We have a quick question here from Yasmin. Would you say that you need around $800,000 portfolio to enable a person to retire? I know it's just individual requirement, but just an approximation.
I would say it depends on each person how much you actually need. But one very important thing to remember, that the yield that you're getting, whether it's a 5% yield, 10% yield, 13% yield, that's yield, it's not return. It's very important to understand that. That is, think of it like your interest rate, but your asset could still go up and down. So of course, if you're just going to buy and hold it and you're making 12%, that's 12% a year, right? But it's the yield, it's not the return or the total return of the fund. It's very important to understand that. But typically what I tell people during coaching sessions is, with covered call ETFs, if you're going to go all in on them and you're going to go with, non-leveraged, you're looking anywhere from 7 to 9, 10. With the leveraged, it's maybe 10 to 12. So you could just base your math on that, right? So 10 is a very conservative figure that you could easily get very consistently. So, $1 million, that would be 100,000 a year. Divide that by 12 for the monthly. So just to give you some context, our main portfolio is currently making about 13% yield, 13 and a half. But we are in pretty much all the leveraged ones. So you could get about 12, 13 with the leveraged ones.
So she can easily get 10%.
Easily, yeah. 10% you could probably even get without the leveraged ones.
Yeah. So when we basically reached financial independence, we had about 650 in the portfolio.
Yeah, right? So 650,000, something like that. I can't remember the yield, but
it was around 10% as well, the yield.
Yeah, and back then we weren't all in on the leverage covered call ETFs. Like we had single stocks, right. And it took us 4 years to actually gradually transform our portfolio, I would say. But 10% when it comes to, if you're just doing covered call ETFs, is very, very achievable.
Yeah. And the greatest thing about DIY investing is that you can actually just do a hybrid approach, right? So you can get some in the leverage, some in the non, and then also in growth directly into the index funds, right? So that's, also another strategy to adopt.
It's like you read the next question. I was just about to ask you. We have somebody named Slovak who's asking, have you ever heard of anyone doing a hybrid approach with your stock market technical analysis and your passive income strategy?
We know plenty of people that do a half-half approach. There's literally a billion combinations.
Right.
DIY investing could be very scary at the beginning because there's a lot of options, but the overarching goal should be to figure out what's best for you, and everyone is different.
How you feel comfortable with the approach. And for sure, buying at 52-week lows, or dips, once you see that there's a bear market and it just keeps going down, so you start to get a little bit like anxious and so forth. But once you've been in the market, in the stock market for a few years, you understand that those are in fact dips and they will eventually go up. So if you can grab it at the 52-week low, that's fantastic. You get into the index fund at that time, so you potentially have a nice hybrid approach there. So those are all, great ideas.
Yeah. I mean, there's no shortage of options. I know people who invest in the covered call ETFs, and then with the income, they put it all in index funds. I mean, it just makes them feel more comfortable. They like buying S&P 500 growth, ETF with their their dividend income. So some people just do a half-half approach, or they'll do all growth in their RSPs and just leave them. let them grow. And in the TFSA, go with more the income approach. So they're making an extra $500, $1,000 a month for in case there's an emergency, in case you want to go on a trip, you have that option of doing whatever you want with the income. If you don't need that $1,000, you just reinvest it. So
and that's the real, the biggest benefit of the covered call income strategy is to actually see the income every month and having the flexibility and option to do what you want. Reinvest it directly in the same funds, reinvest it in an index fund, spend it, go out, go on vacation. So that's the best thing about it, is having that flexibility.
It's a big pro.
Money. Yeah.
You have a lot of flexibility. Going back to the 20-year-old that we know, we told them, look, you're probably going to be better off with just the index funds. So we told them, get half in those and half in the income. See which one you feel better, which you feel more comfortable with. After 6 months, they switched to the income because they just love seeing that income coming in, and they could spend it or they could reinvest. And I think now, these are kids who are just starting their careers, and they're at $500 or $600 a month, and they're motivated to keep going. So there's a lot of pros, with a lot of psychological pros with the income approach as well.
And the best thing from this example, the two 20-year-olds, is that they already know, in 10 years what their FI number will be. So they actually have a direct goal to achieve. So because they see the money just compounding every month, they actually could count down to when they could potentially retire or be financially independent.
Yeah.
That's very cool. That's very cool. Interesting question. And this one's coming from Yale, and it kind of falls into what we're talking about. We've talked a lot about RSPs, tax-free savings, but there is also non-registered. How is the income from these funds taxed? Of course, the tax man is always going to come.
It's a great question.
Panama. Tell us about taxation.
Besides the Panama, which is just a completely different story in terms of taxation, they're actually very tax efficient because call premiums, which is mostly what you're going to get with these funds, most of the income is option income. And option income in Canada is all treated as capital gains. So this is all capital gains, which is very tax efficient. So you're going to get a combination, but most of it is typically capital gains in ROC. I like to consider ROC as delayed capital gains. That's just how I see it. But if you're investing in a Canadian covered call ETF, there's going to be dividends in stocks in there, Canadian dividend stocks. So a portion will probably be eligible dividends. So it could be a lot of different things. There could be Canadian eligible dividends, maybe a little bit of foreign income, just like an S&P 500 will give you foreign income, right, on that little dividend from those US dividend stocks. But when it comes to covered call ETFs, most of it, the big majority is capital gains and ROC income.
Yeah, it's also worthy to note that it does depend on the performance. So if 2022, for example, was a bad year, the tax within the ETF will be more ROC.
We'll have a lot more ROC, return of capital, which there's big misconceptions about ROC. I don't want to get into that now. People just think it's their money back. It's not really true. But they're very, very tax efficient, mostly capital gains and ROC, which is what you want in higher tax brackets. I know in lower tax bracket for Canadians, eligible dividends are better, but capital gains are still there as very tax efficient funds. That's why you typically always see the language on a covered call ETF fact sheet or ETF fact sheet, tax friendly or tax efficient distributions. That's why.
Yeah, and so if you want to look more into detail, you could just pick a covered call ETF. You could go into the fund and you could see what the previous year,
the
breakdown was of the taxes. So
they're much more efficient than bonds and fixed income, which is regular income. So capital gains, as we know, is 50% better than regular income. This is, of course, we're talking about the non-registered, right? TFSA, RSP.
Of course.
Different.
Doesn't matter.
Everything else, different ballgame. We had a follow-up question on the leverage piece, which is totally valid. So Yasmin's asking, so the only reason to do leverage is to get a higher return. Is that what we're saying about leverage?
Well, yes, but as an income investor, I believe the main goal is to get higher income, right? If you're investing in a leveraged covered call S&P 500 ETF, you'll get 12%. The non-leverage will get 10%. So you're getting more income every month, You're taking more volatility for more income. That's a trade I would make any day of the week, because I don't really care about volatility, the day to day, month to month, year to year. Capital.
But to address the question, the reason why these products exist is, yes, in fact, to get like an advantage over a non-leveraged.
It amplifies it. So there's also leveraged growth ETFs that are actually have just started coming out now in Canada. So it would be the same thing. So if you're just adding a little bit of leverage on something, you're going to get more volatility. You're going to go down 25% more during a down year or down month, but you're going to go up more during an up, right, month or period of time. But for the income investor, it's really more about getting that extra typically 2% more yield, which makes a big difference.
This makes a difference when you're like us, where you're looking at your overall income every month. This is your main source of income. So you're trying to squeeze as much out of your portfolio as possible. So that's really the advantage of the leverage when it comes to income investing.
Over time, they should beat the non-leveraged over time, because the market goes up more than it goes down. But if you're just going to compare in the 6 months where the market was bad, they're going to obviously perform worse, right? Yeah. So the key is to have a long-term view. This is just my personal opinion. If you're a long-term investor, like 10-year plus, I would always go with a leverage option if there is one. Does not mean you're going to get 25% more return. However, very important to remember that. You could just get a little bit more. If during that 10 years, for example, was a disaster, you'll probably get less. But the yield as an income investor, it really shines because you get more income.
Yeah, we always say, like, if you can invest in both the ETF without leverage and with leverage, and then see for yourself, the difference per month, and how it looks in your portfolio, and see which one you're more comfortable with.
Yeah.
For sure. And also to keep in mind, we mentioned earlier about going to the fund website and understanding what their covered call, strategy is also very important with these leverage ones, because some of them you're talking about, 25%, but there will be some that would have more leverage. So definitely want to make sure that you're kind of looking into those funds and understanding, and not just seeing leveraged and moving forward. You want to make sure you know exactly what that looks like.
Absolutely. Yeah. That's a great point.
Yeah. You gotta know how much leverage, for sure, right?
Yeah. Okay, awesome. I think that covers that. That's great. So Swapnajit, hopefully I've pronounced that properly, is a covered call ETF good under long term? That's the question. So you've addressed a little bit talking about long term, but is this something that should be considered for long term?
Yeah, well, I mean, S&P 500 is great for the long term. Why wouldn't an S&P 500 with covered calls be good for the long term, right? So you're investing in the same assets, the same thing. Investing should always be long term, in my opinion, right? Anything short term, that's speculating, that's trading, swing trading. That's not what we do. We're long term investors. But we have to admit that over the long term, if total return and performance is your number one priority, covered call ETFs will underperform.
Yeah. So if you're holding the covered call ETF and you're just reinvesting every month and not spending the monthly income, compare it to a non-covered call ETF with the same holdings over the long term, and we're talking about, like, obviously with nothing drastic happening in that time, then the ETF with no covered calls will have higher total return than the one with covered calls.
Yeah.
So I assume that under the long term, meaning, is it, total return wise, is it good, right? So again, it depends on your needs. For example, I'll give you another scenario with the covered call ETF. If you're receiving the monthly income, eventually the monthly income will surpass your actual, the amount that you've invested into the ETF. So you will be at a break-even point, basically. So everything else, you have already paid back your initial investment, and everything else is just pure monthly bonus. So the longer you hold it, the more income you'll receive. You'll pay back your initial investment, and you'll make income every time. So there's different ways to look at it, right?
Yeah, there's pros and cons. Yeah. But in terms of which ones are going to have the most total return after 10 years,
without touching them,
without touching them, it's always going to be more the growth ones, the index funds, which it's really because of fees. They have the lowest, almost non-existent fees. So even with the reinvest, when you look at total returns, it includes, like Erica mentioned, reinvesting. right? It includes as if you're dripping them. So the answer is yes, they are good long-term, just like dividends ETFs are good long-term, and index funds are good long-term. But the winner will always be the low-cost index fund. It's always going to be the dividend ETF. It's always going to be the covered call ETF.
Well, what about a covered call ETF with leverage?
So that's another reason why that 25% leverage on the covered call ETF is very interesting, because it helps to close that gap a little bit over the long term. But even with that 25% leverage, most probably it will still underperform
because of the management fees.
The management fees, but it will perform a bit better than most probably the one without the covered call without the leverage. So that's why we really like the 25% leverage as well, a strategy. Yeah.
Well, you talked a bit about the downside piece too, where you're receiving the premiums that will continue even if the market is down. So we tend to look at that as a risk return, right? If that's kind of lowering, it's giving you a bit of downside protection, then you do have to forego some of the potential growth, right? That's just the way it works with investing. If you have downside protection, you can't have everything. Wish we could, but unfortunately you can't get the most return, and then the buffer too.
Yeah, I mean, people invest in fixed income not for maximum total returns, right? So it's for more stability, less volatility, more safety. So covered call ETF is really the same thing. You are giving up some upside.
Of course. Perfect. Yeah, I think that definitely covers the bases with that one. Dan has a question here about withdrawal rate. So what is a healthy withdrawal rate with dividends?
That's very subjective. There's no black and white number, I would say.
So the goal is to live off the dividends or distributions. So essentially, you don't really have to withdraw your capital if you're able to live on your dividends and distributions. So that's the beauty of cash flow income style. But withdrawal rates is something subjective as well, depending on your lifestyle, how much your living expenses are.
So living off, there's a, when people think living off my investments, they're basically, I'm just going to spend all my dividends, all my distributions.
Don't touch my capital.
Don't touch my capital. That's fine. You also have to make sure the fund is ideal for that, because you have these, especially in the US, you have these very, very high yield, 30, 40, 50, 60% yield funds. If you're just pulling out the entire dividend every month, well, those are not ideal to live off of. So you also have to make sure to choose funds that are ideal to live off of. My personal sweet spot is in the 10 to 15% range. After 15% yield, most likely you're going to have no choice but to reinvest a portion to maintain that capital, right?
Talking about that, I just have a quick question. You talk about the idea of capital, leaving capital and taking just the income. Is there ever a point in time that that you're going to have to start drawing on capital?
Well, it hasn't happened for us.
It depends on the fund. It's very important. It depends on the fund. But I would say no. Most of it, especially on the Canadian side, a lot of these are actually very good.
For you specifically, like your plan, does your plan ever include depletion? No. Very cool.
Not so far.
No. We haven't thought about that. going and what are we going to do with the capital after?
I don't know. Spend it.
Yeah.
Spend it. Zero when you die. Or whatever. Right now we're die with zero. Exactly. Yeah. We're still growing it. Because it's really, it's simple. The more monthly cash flow you have, the better lifestyle you could have, right? So it's different for everyone.
Just interested.
Priorities,
Okay, question here from Bruce. So talking about where you live, the lovely location you are currently living, how does living abroad affect your CPP and OAS pensions and your tax situation?
Yeah, so we'll start with the CPP OAS. And just to start with, I'm not an expert in tax stuff, but like any other retiree who leaves Canada and becomes a non-resident, you still get to keep your CPP and OAS. There's going to be most likely withholding taxes, depending on which country you go to, if there's a tax treaty or not. As far as I know, that's how it works. So Panama does not have a tax treaty with Canada. So the universal Canadian withholding tax rate is 25%. But if you go to the US or Australia, it could get reduced to 15%. I'm assuming that's going to impact, or that's going to be also on your CPP and OAS. So in terms of taxes in Panama, it's a territorial tax system. So there's no tax on any foreign income that you're making. So our tax situation is obviously a lot better than it used to be. But you still get to keep your TFSAs. They're still tax free.
You can no longer contribute.
You get no more contribution room though, when you become a non-resident in Canada. So if, this year there was an additional, $7,000, we weren't able to contribute that amount. So we don't get any more contribution room. RSPs, if, right now they're just compounding, but when we do turn them into RIFs and the lira into a LIF, it's all the extractions is 25% withholding, because that's just the universal tax rate. But in Panama, there's basically no taxes because it's
on foreign income.
On any foreign income, including from our investments. There's no tax because it's
so it's no tax to Panama, but still, we're obviously paying the flat rate to Canada from our investments.
Yeah. Mm-hmm. Yeah. So that's the RSP. And the cash account is the same thing. It's a 25% withholding tax right off the top on all the dividends. But there's a rule where at the end of the year, once the tax information, the breakdown comes in, like we were discussing earlier, right? Dividends, ROC, capital gains, we do get reimbursed the ROC and capital gains portion as a non-resident.
Okay, cool.
So hopefully that answers that question. I have videos that specifically discussing this in detail, by the way, on the channel.
Right, on your channel, you always have more detail.
Yeah, it was the first time we experienced the tax season, so we published a couple of videos to discuss all that. Yeah.
Okay, awesome. I'll have to check them out for more details on that. Gregory has a question, and I have this question as well. Do you rebalance your portfolio at all, and if so, how often?
I get that all the time. The answer is you don't have to. It depends how you invest. If you just going to invest in S&P 500, NASDAQ 100, what's there to rebalance, right? And that's more and more where our portfolio is heading. So the answer is it really depends on your portfolio. You don't have to. If I see, we say buy and hold a lot, and I've been criticized, you're making so you make always changes in your portfolio. The idea of buy and hold is still the same. When I buy something, I want to hold it forever. I want it to pay me every month. But if there's a new product that comes out, which they've exploded in the last couple of years, and it's better for some reason, I like the strategy better. I like the holdings better. It's more efficient. If I see some I call it streamlining moves, so I could swap things into that new fund, for example, and streamline my portfolio, I will do that. So the answer is, if you're just it's just like a growth investor. If you're just going to buy S&P 500 or these classic index ETFs, you don't really need to rebalance. So it's the same thing for the income style. There's really no difference.
Those are all great pieces of advice. I've completely fallen in love with your cat as well during this session today. It's been adorable. There's been stretches, repositioning. It's the highlight of the chat, to be honest, for me. The cat's adorable.
I didn't even know
she's a cutie. Yeah. She's a rescue,
I get distracted easily.
Yeah.
What was it?
Yeah, she's a rescue.
She's a rescue. We rescued her here in Panama, and she was so skittish at the beginning, but now it's about a year we have her.
Now she owns the house.
Yeah, now she's so comfortable. So.
I can tell on the countertop there. They're so cute.
Yeah.
It has been a pleasure.
Great, so. Yeah, I was just going to say, we're involved with the helping the animals here.
Yeah.
So financial freedom, it's not just about, getting yourself with a budget and being free, but you also have time to do other great positive things in your community. That's a very big plus where, we didn't even have time to think about that during the 9 to 5 grind. So financial freedom should be everyone's number one objective, I would say.
Absolutely. You can follow your passions. You can follow your passions and volunteer and those sorts of things. Love it.
Yeah.
Okay. Thank you so much for taking the time. Thank you to everyone in the audience. We have a survey after today's session. We would love your feedback on today's session and about any future things you'd like to see, any ideas you have for upcoming sessions for us, as well as upcoming events. So check out those, register for anything you're interested in. We have Options Education Month coming up. So lots more where this type of conversation came from on options trading if you want to do it yourself. Again, thank you so much, Adrian and Erica. Really appreciate it. I've had a blast having this conversation with you, and we'll look forward to chatting with you again in the future. Bye, everyone. Take care.
Thanks so much. Bye, everyone. Thank you.
Have more questions? Check out the links to the right and in the description below.